Hi everyone, my name's Bernard Doyle, JBWere's New Zealand Investment Strategist. This is just a quick update on how we're seeing markets, the world economy and the New Zealand economy. Stuck in first, probably a little unkind to President Trump, but maybe apt given the photo. More importantly, we don't see the world economy is stuck in first and are actually pretty happy with what we're seeing with global growth this year. We think that the world's going to grow close to 4% in 2017, and most importantly, we like the quality of what we're seeing. We're not overly reliant on a single country here. Obviously, the likes of China is still very important to us, but we think there's a good balance and sustainability to growth when we look through the individual countries. Some of the laggards of prior years, such as Japan, in much better shape. Europe, the European economy is in better shape. And so we just like the fact that we're seeing some good signs in some of those very large and important parts of the world economy. This comes back to business confidence. I think, if you look back to 2014 and 15, the collapse in the oil price, while it was good for consumers, it hit a lot of businesses around the world that were associated with oil production. And so the stabilisation there has helped recover business confidence. But there's more going on than that, I think. When you look at the US, and this is the chart on the left showing manufacturing and non-manufacturing confidence. Non-manufacturing is so important because it's a big employer. It's obviously the services industry these days is a much bigger employer than the manufacturing industry and manufacturing sector. But importantly, both sectors are confident. And if you look at where you get into trouble as an economy, it's when you drop below average or you drop below the 50 level, either or. But that's when, if you have both manufacturing and non-manufacturing businesses losing their confidence, you're in recession, which is the shaded area on the chart on the left. And we're a long way away from that, which is positive. On the right-hand side, just shows you, quite extraordinary, really, that given some of the politics we're going through in Europe. From Brexit to an Italian referendum, we're in the midst of a reasonably contentious French election. We've obviously had the presidential election out of the way, and we're into the parliamentary elections next month. But it doesn't seem to have affected business confidence, which is close to certainly decade highs in most of these key countries. And a great example is a country like Italy, which Italy's in not great shape, I would not think, given the politics is very unstable there. They have a banking system that is struggling, but you can see here business confidence in Italy has recovered quite strongly over the past couple of years, which is good to see, and again speaks to a lower recession risk than we think we've faced for many of the last 7 to 10 years. What does this all mean? Well, businesses have been hiring, which is great, and that's starting to feed through to earnings growth. This is one way of looking at that picture. This is the United States, but again, this story is happening in many other countries. Because businesses have been hiring steadily, really for the last 5 years, you're starting to see employees get confident about their ability to either ask for a pay rise or hunt for jobs, switch jobs in search of better earnings. That's a very good leading indicator of future wage inflation, as this chart shows. And so, we expect to see wage growth continue in the US and in other countries to increase. That should keep interest rates on at least underpinned. It may not push them ever higher, but it should stop them falling. And so that leads our confidence in the chart on the right. We think that the 35-year bull market in the bond market, which obviously enjoys falling interest rates, is over. And some of the extraordinary returns that have been generated by the bond market are behind us. All that said, we're not looking at interest rates moving significantly higher. We expect maybe another % or so is likely. For that to happen, we really need to see some of this wage growth flow through to broader inflationary pressure, and that'll be interesting to see how much that plays out in 2017. Why is it interesting? Well, the behaviour of the Fed is critical, and they will be watching inflation closely, and we'll be watching the Fed closely, because if you look at post-war bull markets, the Fed's been a common factor in the end of most of them, if not all of them, but certainly most of them. The table on the left shows that at the end of prior bull markets, we're in a situation of falling unemployment, rising inflation, and rising interest rates. So we think we're getting into that territory now, which keeps us watchful of the behaviour of the Fed, because we think most likely, and as you can see, risk one of the end of the bull market, we think will be the Fed sucks the oxygen out of the equity market by raising interest rates in an effort to control inflation. And so while inflation is very well behaved, it will probably keep the Fed from being too aggressive in raising interest rates, which should be a good thing for the equity market. The second risk to keep an eye on is imbalances, and where I say imbalances, you could say debt. The two biggest problems we've had in our world economy and financial markets over the last 20 years have been caused by imbalances. That was the financial crisis, way too much borrowing into the housing sector in the US in 2006 and 7. Prior to that was the tech bubble, way too much borrowing in the business sector in 98, 99, 2000, and it all ended with the tech crash in the 2 years that followed that. So we have to watch imbalances closely. When we look at the US financial system, we're not seeing too many signs of imbalances, and in fact what these charts show you is debt to GDP in the household sector and across the board has been very well behaved for this stage of the recovery. In fact, household debt's been reduced significantly as a proportion of GDP. So if the US isn't a worry for imbalances, where is? Well, this chart from the IMF summarises what we'd say is the biggest glaring imbalance in the world, and that's Chinese debt growth, which is growing at a rate that is on a par, if not more aggressive than prior bubbles or booms that ended in a bust in the last 30, 40 years. And so this is an economy that bears close attention, because you cannot grow debt this quickly for very long. And as we say in the title here, we don't think China's heading for a crisis this year. I actually don't think China's heading for a crisis full stop, but they'll definitely need to slow the rate of their debt growth, and that means they'll have to slow their economic growth. So over the next 5 years, I'd expect to see much slower growth out of the Chinese economy. I don't think that's necessarily a bad thing for the world economy, but obviously, that transition is something worth watching very closely. The third risk to the world is politics, and we've had an exciting 12 months in the political arena. It's not over. Obviously, we're in the middle of the French election. We've had the presidential stage of that completed, and we're up to the parliamentary election. But of all the European elections that are on the calendar this year, it's one that's not on the calendar that interests me most, and that's Italy. It's not due for an election actually until next year, but they could have a snap election really at any time. And Italy worries me a little bit because you have a very strong protest movement in the political sphere there, and that's what the chart on the left shows you. The attitude to Europe is a little weaker in Italy than in some of the other core EU countries, and the Italian economy hasn't been doing great. It's got a struggling banking system, unemployment's very high. So if I was going to say what could cause a big upset on the world political stage, it would be Italy wanting to have a referendum on their involvement in the European Union and in the Euro, and that would be a big event. There's no inkling that that's on the horizon, but in terms of risks, that's one to keep an eye on. So that's the world, but on to New Zealand. Unhappy growth is how we see this economy. Is that unfair? Well, it just really reflects the fact that growth is very narrowly sourced from population. We're in the middle of a migration boom. It's more than tripling our rate of population growth from our natural increase, and that's leading to a very strong building cycle. So, it is what it is, but it's not necessarily that helpful to even those companies that are directly involved in the building cycle, and their profitability has struggled in this environment because we've run out of spare capacity really to grow purely around building houses, and that is really our speed limit. And so, we certainly wouldn't describe the growth in this economy as particularly friendly for the equity market. And from this starting point, we are conscious that it's hard for things to get better in a growth sense. And when we look at New Zealand's history, growth can slow quite sharply. So even though there's nothing obvious to us to suggest that we won't have a nice soft landing over the next few years, we have to be careful. I mean, immigration is a very volatile driver of growth. So are commodity prices. And if either of them slowed sharply, this could be a much tougher environment for us. So we have to be conscious of that as equity investors. And obviously the politics here is, whilst it's not a patch on some of the, volatile politics of the European and US economies, we are heading for an election that will be most likely a close run thing due in September. When there has been changes of governments historically, that's been certainly a short-term hurdle for our share market. And then finally, just a comment around the Reserve Bank and our currency. So on the face of it, there's no reason why New Zealand needs low interest rates, and the Reserve Bank could be raising interest rates. We've just seen this week, real retail sales running at around about a 6% annual rate, so very strong. Similar sort of rate in employment growth released last week. So when you look at the domestic economy, it's thriving. Now, there's one area that's not thriving, and that's, funnily enough, the housing market. House sales, as you can see here, have slowed for 6 months. And for that reason, I think the Reserve Bank will be, doesn't need to rush into raising interest rates. This is the most interest rate sensitive part of the economy, and it already is in a little bit of a slowdown. You can see, just as a matter of interest, historically, that has been a good guide of currency, and that's one of the reasons we struggle to see the New Zealand dollar booming anytime soon, unless we see those house sales start to recover. So, we're happy with the idea that Reserve Bank raises interest rates either late this year or early next year, but we don't see any need for them to feel pressure to raise interest rates sooner than that. So look, I hope that was a reasonable snapshot of how we're seeing things in New Zealand and around the world. From an investment perspective, we are encouraging investors to be fully invested. We like global equities. We're holding a little less than normal in New Zealand equities, just reflecting some of those challenges I talked about. But when we look at, adding all our equity allocations together, we think holding as I say, being fully invested, holding your normal allocation makes sense. We think bonds probably are going through a slow patch still, but that said, they remain a very important part of your portfolio, as interest rates rise, they will become far more interesting to us as well. I'll finish there. As always, please make contact with your JBWere advisor if you have any further questions for us at all. Thank you.